The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to ACEC-RT's December webinar, where we will be discussing budgeting. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write any questions you have during the webinar using the Q&A tool in the webinar menu. At the end, we will take the time to go through these together. Now, I'd like to introduce you to our guest speaker of Prudential, Dallas Chestian. Dallas is a regional retirement counselor and helps participants with understanding individual investment options, developing sound asset allocation and saving strategies, and navigating administrative processes while using dynamic retirement planning tools. Dallas entered the financial services industry in 1995 and joined Prudential in 2008. She has a BA in Labor Studies and an MA in Behavioral Science, both from California State University, Dominguez Hills. She holds her Series 6 and 63 registrations, as well as life, health, and variable annuity licenses. Dallas is also a certified retirement counselor. Thank you for presenting today, Dallas, and now I'll turn it over to you.
Well, thank you, Renata, and welcome to all of you that are joining me this afternoon. Thank you so much for taking time out of your busy schedule to learn a bit more about how to go about creating a solid budget. That's the theme of today's webinar. And as we know, budgeting and saving works when it comes to covering your fixed monthly expenses. It is one of the best ways to prepare long-term for retirement. This webinar will show you the importance of creating a budget and how to establish some easily adaptable methods to save for retirement. Now, when we think about retirement and when we think about retirement age, typically we use 65 to determine our strategy. Yet, if you think about how old is the oldest person you know, you'll see that in many cases you may know someone that is way beyond life expectancy, maybe in their late 80s, 90s, or even approaching 100 or better. And you may have someone in your own family that is approaching those later ages. And so when it comes to retirement, we know that we're living a lot longer, so it's time to start planning for that longer retirement. So when it comes to budgeting for a better retirement outcome, we want to take a look at a number of different things that we have to prepare for. First and foremost, we have to understand what is a budget. It's really determining what your income is and what you're spending in order to then see what you have left over to save for the future. Why should you create a budget? It's important because it helps us track our spending and look at things that we may be able to not spend our money on in order to put towards something that will benefit us in the future. Where to begin? Very easily, we do have a worksheet that we'll provide to you so that you can start documenting all of that information. Automating your budget makes it simple, such as if you set up those automatic monthly payments, then you don't have to worry about going in and making those payments on your own. And look at some of the things that you can do next in order to prepare financially for your future. Now, when it comes to our financial future and making good choices, it's sometimes a little bit difficult. It's maybe a little bit of a struggle, even though we know it's the right thing to do. It seems that our brains are just not hardwired to make rational decisions when it comes to saving for our retirement. We worked with a team of psychologists to determine the 5 most pressing human behavior obstacles that stand in the way of securing long-term financial security. I want to go over those with you because it is important. As I mentioned, we all want to do well for ourselves, but we find that there are certain obstacles that get in our way when it comes to our financial well-being. The first is the longevity disconnect. That I might live how long? If you were to close your eyes right now for just a moment and try to picture yourself at age 65 or age 70 or beyond that, it would probably be a little bit difficult. We know our past selves, and we certainly know our present self, but to see ourselves in the future, very challenging. And typically we see ourselves as a stranger. And if that's the case, then why would we save for that stranger? So it's important then to connect to your future retired self in order to be able to put away those extra dollars so that you can live the lifestyle that you want. You will thank yourself later for taking all the steps that you are today. The next one is procrastination. I'll do it later. I know I'm certainly guilty of that many times. And on average, individuals will procrastinate 2 hours per day. The harder the task, the more we will procrastinate. When you think about putting together a budget, that might not be on the top of your priority list. And so if it is something that you find challenging or that you just don't want to do, you'll continue to procrastinate and put it off, when in reality it's something that should be done as soon as possible. So think about your future. Is there something you can do today? And if so, do it. Don't delay, as they say. The next one is optimism bias. It won't happen to me. That's that preconceived notion that bad things will happen to others, but not to us. It's great to be an optimist, to see the world through those rose-colored glasses. The glass is always half full. On the other hand, that may cloud our judgment when it comes to risk, because we know that there are many unanticipated events that occur in our lives, and we need to be prepared for those. So instead of having that outlook all the time, know that you also have to be a realist, because if there are things that come up all of a sudden, we need to be prepared for those. If you are saving just a minimal amount of money for your future and think that that's going to be sufficient for you to be able to live comfortably in retirement, you might want to give that a second look. The next one is overreaction. I just can't resist. This is where we let our emotions rule our long-term decisions, particularly when it comes to investing. We saw what happened in 2008 with the market decline. Many people started to panic, and so the herd mentality kicked in. We want to make sure that when we're looking at our savings or investing, what we're doing for the long term, that we don't get caught up in the day-to-day, and that we don't emotionally react every time there is a situation that occurs. Always focus on what is the long-term goal, what is your long-term objective, and do you have the right strategy in place to reach that goal? And if so, then let it work for you versus, once again, letting those emotions lead you to making certain decisions that may actually impact you negatively in the future. And the last one is impulse control. I want it now. This is something that we are all guilty of, particularly now with the holidays coming. There is definitely a lot of impulse purchasing going on, and that's where we're just simply preconditioned to want things now. It's hard to think about delaying gratification for something in the future, but it is important when it comes to our financial well-being, because that's going to help us then have the kind of money that we need to live the lifestyle that we want. So when it comes to these particular challenges, which all of us, as I mentioned, most likely have encountered at one point or another, it's really to make you aware of the fact that it's time to stand back for a moment and analyze and think about, is this something that I really have to have, or is it something that I can essentially put aside and that way have more for my future self that I will become, that I will do it today and not procrastinate and delay putting aside more money for myself, making sure that, as well as being optimistic, that I'm being realistic about things that can happen in my life, and making sure that I don't overreact every time I hear the news or there's something going on in the stock market. As long as I have the right strategy going forward, and that's what's going to give me that comfort and that confidence that I'm going to have what I need to live the lifestyle that I want. Now, there's no doubt that there are many ways that we can save today for our future. And so these are some of the strategies that you can start to think about and utilize as you move forward in this journey of life and move forward towards that day one of retirement. So the first one is investing for a long retirement. You want to make sure that you have the right mix of investments in your retirement account. As you approach retirement, many people become more conservative with their investment approach. But you want to make sure that you don't become too conservative in your fund choices too early, because you will need some growth potential to help you stay ahead of inflation during that long period. So this is a good time then, particularly going into the new year, to look at your investment strategy. Is it appropriate for you based on your age, based on your comfort level with risk? And to also just ensure that you have some potential for growth while also protecting those dollars depending upon what your particular goals and objectives are. Another thing to consider as we move forward is to make sure that you increase your contributions on an annual basis. That is, even by 1%, that will make a huge difference over time. When is the last time that you increased your contribution? 1% really doesn't impact your paycheck as much as you may think. And so this is a good time to think about your strategy in 2017 and forward. But that 1% really does add up. And we do, there are many resources out there where it can show you how that will impact your future earnings and growth on your dollars. The next one is to take advantage of catch-up features. If you're already at the maximum, that is, the IRS allows you to save $18,000. If you happen to be 50 or better, though, you do have the opportunity to utilize catch-up, where you can save an additional $6,000 for a total of $24,000. These limits will be the same going forward in 2017, but this gives you an opportunity to really do more for yourself. And you can also consider supplementing your savings with an individual retirement account. These you can open at any time. The limits are a little bit lower because you are an individual, so you can save up to $5,500, or if you happen to be 50 or better, $6,500. So there are various ways of making sure that not only are you taking advantage of your employer's plan, but also other opportunities and investment vehicles outside of the plan, such as savings and, of course, individual retirement accounts. Now, when it comes to college and retirement, you really want to consider focusing more on retirement. If you happen to be a parent and you have college-bound children, or you're looking to pay off your student loans, most likely that's not going to be the best approach, because you definitely want to make sure that you fund enough for yourself, for your own retirement. As we know these days, many companies do not provide a pension plan. Social Security will only be a very small portion of your retirement income, and therefore really want to make sure that you focus on putting as much aside for your own retirement and for your own well-being, because your children or students, they have other options, such as scholarships and student loans. And so tapping into your retirement or not saving enough for your own retirement because you're paying for those college expenses, again, may not be the right approach, particularly depending on your time frame for retirement. The next one is to consider refinancing your mortgage. Your home can definitely be a source of extra retirement money. First, though, stay on top of those interest rates. If they fall enough, you might consider refinancing and directing any savings from that to your own account or your own plan. Generally, try to economize on such things as utilities. See that your home is well insulated, and sign up for your utilities budget plan, which can be helpful in controlling those monthly expenses. Check out budget plans. There are many different ones out there. You can create your own. As I said, though, we do have a budgeting worksheet that will be shown to you at the end of the presentation, and something that will also be supplied to you in the event that you would like that in order to create and track your own budget. Now, tracking spending is definitely one of the big ticket items here. So the biggest thing you should remember is to make that budget and then stick to it. Track what we call mystery money. That is that $3 latte that you have here and there, the lunch out instead of brown bagging, the $7 weekly car wash. These are types of expenses that we all have, but they can add up really quickly without us even noticing. So these are things that you may want to begin to track because it doesn't sound like much, but if you were to look back on the last week or your last weekend and you start to itemize all of the things that you purchased, you most likely will find that many of those were impulse purchases, not things that you needed, but just things that you wanted. You can take those dollars and set those aside for your future. Another way of saving today for tomorrow is to review your insurance policies. Look at your auto insurance plan and premium, particularly if you do have college-bound children on it. And if the kids have left for good, take them off the policy. If you're simply away at college, ask about a distant student credit. So a number of different things that you can review. Certainly your homeowners. Are there ways of consolidating those various policies so that you can get those lower premiums and lower your overall cost? If you've done most of these items already, though, another way to find extra money is by clipping coupons. Certainly, it may take a little time to do that, but you can save some money there as well. Many restaurants now offer the buy one, get one free, or even with clothing or other types of items, or groceries, car washes, all of those things. So that's another way of saving that can definitely add up for the future. Now this is an interesting one, and one that you might not find all that appealing, but consider working a little longer. That is, don't retire just yet if you don't have to. Each year that you postpone retirement is another year you can continue contributing to your plan, one less year that you will withdraw from your plan, and another year you postpone applying for Social Security benefits, which means that those benefits might be higher when you eventually start taking them up to age 70. Now, when it comes to Social Security, as I mentioned, it is going to be a small piece of your retirement income. It certainly is an important one, though. And what I have discovered over the years is that many of us don't necessarily pay too much attention to our Social Security information. And it's been a while now since Social Security has been actually mailing out statements to our home. So what I encourage you to do, if you haven't done so already, is to go out to the Social Security Administration website, that's ssa.gov, or just simply type in Social Security. And then you'll find there is a link to My Social Security, which then allows you to create a user ID and a password. That is, you will, of course, be asked some questions that only you would know. Once you have been verified, then you would be able to create your credentials and then get access to your most current Social Security statement. It is important that you monitor that you look that information over, because as we know in this day and age, with computer errors, identity theft, human error, all of those things, there could be a glitch. There could be something on your Social Security statement that doesn't belong or that is not correct. And you want to correct that now, not wait until you're 62 or your full retirement age to collect and then find out that there's missing information. So this is really important. Once you have access, then double check all of your earnings history. Have all of your employers sent in that information correctly to Social Security? What about your name? Is that correct? Your address, your Social Security number, your date of birth, your year of birth. I've encountered a number of individuals who have told me that there was definitely erroneous information on their statement. That is the time that you want to then get it corrected. The other piece, though, is that Social Security then provides you with information about what you would collect based on whether you start early at age 62, if you wait until your full retirement age, which used to be 65 for everyone, but now, of course, it's different based on your year of birth, and then what you would collect if you were to wait until age 70. So there's a lot of useful data there that you want to look at and understand, because this is part of your overall financial well-being and part of your process here that you're going through. So make sure that you do that. It only takes a few minutes. And then once you have that account set up, Social Security will send you an email 3 months prior to your birthday indicating that your information has been updated. This now gives you an opportunity to go into the system, access your statement, print it, and then review it for accuracy. So we are responsible for our own data and for our own information. And so please, if you haven't done this, do so, because that then will give you more of that comfort and confidence that everything is in order. And that way, then you can rest assured that when you get the next one, you can review it, put it in your file, and you will be set. Now, lastly, one of the things that you can do is to give retirement a trial run. Now, this is an interesting one. What you want to do is decide how much you want to live on annually, and now, while you are still working, try to live on that amount for a month. This can give you a really good idea whether your goal is reasonable or not. And I've encountered a few people along the way that have actually tried this, and it is a challenge because you definitely have to change your spending habits, but it is a good way to find out if what you will need is going to be sufficient in order to live the lifestyle that you want. So a number of different strategies that you can use now while you're going through this budgeting process and thinking about your financial future, of how you can incorporate them in order to save more for you. Now, believe it or not, there is all kinds of debt, as we know, and there is good debt and bad debt. So, for example, buying a house is a way to build home equity, which can later be turned into retirement assets. Now, of course, want to look at the home that you buy. It should be affordable relative to your income and lifestyle. Be sure to consider such things as your property taxes, insurance, and maintenance when choosing a home, because as you know, this is a long-term investment, not a short-term cash opportunity. In life, every phase that we encounter will require money, and therefore you want to even look at the future, thinking about what types of expenses you might encounter with your home, because even though it may be paid off, there's still going to be those additional costs, such as those property taxes, insurance, and certainly maintenance. A college loan may be good debt as well. Investing in your education and that of your children is rarely a mistake. Nevertheless, be sure to consider the cost of school as compared to the career opportunity and income you hope to realize, to make sure that you understand all the aspects of your education investment. And lastly, taking a loan to buy a car can be good debt. Buying a new or late model, used, reliable car and driving it long after your loan is paid off can be another smart financial move. So there are good debt out there, and as you can see, these are 3 examples of that. Now, which can be considered bad debt? Well, this is one that we're all definitely familiar with, and that is credit card debt. Now, credit card debt is the 3rd largest source of household debt. Only the mortgage and student loan debt markets are larger, as you can see here. The average U.S. mortgage is $156,333. Student loan is $32,953, with credit card debt falling in 3rd place here at $15,760. It's interesting, too, that the number of credit cards you have obviously can be an issue. The average number of credit cards per U.S. cardholder is 9.5. Do we really need that many? Well, some would say yes, some no. But as we know, in this country, we definitely rely on credit cards for much of our purchasing. Now, if you do have credit card debt, here are some things that you can try to get this debt paid off. Keep a minimum number of credit cards. And for the ones you do have, make sure that you get the lowest interest rate when possible. This is something that we should all definitely be focusing on when it comes to our credit cards. Try to pay more than the minimum on those revolving balances. and reduce or stop altogether if possible, making additional charges. Now let me give you an example of what happens if you just pay the minimum on your cards each month. Suppose you owe $1,000 on your credit card. You have a 21% interest rate with a minimum 2% payment due of $20. If you only pay the minimum, it will take you 235 months or nearly 20 years to retire the loan, and that $1,000 purchase will have cost you $2,800 in interest. If instead of $20, you pay $100 a month, you will retire the balance in 1 year and pay $109 in interest. Now, it's great that the credit card companies now, when you get your statement, that they show that information. So now you know for sure, if you make the minimum payment only, how long it will take you to pay that off and what those finance charges will be. So this is a good way of reminding every one of us who have credit cards to pay more than that minimum in order to get that debt paid off as quickly as possible. You can make an extra payment against the mortgage on an annual basis. So rather than having to pay extra on credit cards, consider what you are buying before you even pull out that plastic. So it's always a matter of, again, looking at, is this something that I really want or do I need it? Consider using cash. It's a little bit more difficult for us because we definitely are much more reliant on plastic, but having cash, it's more real, and so no doubt it might be a little bit more challenging to get that cash out, and we probably think twice about it versus just inserting that credit card into the machine. So think about that. When you think plastic, pause first to make sure you really want the item. When it comes to, again, paying extra on the mortgage, this is definitely something that will help get that paid off that much sooner. And make sure that you direct the money to go to the principal. If your lending institution allows, pay bi-weekly instead of monthly. You're basically paying the same amount, but you will retire the loan quicker. Although mortgage debt is one of the better forms of debt to have, as we saw earlier, you will find retirement to be more affordable without a mortgage than with one. The next is to consolidate loans. Consolidate those loans where interest rate and term considerations make it the prudent thing to do. If you are finding that the payments on your loans are becoming too burdensome, don't ignore a bill. This is where you have the opportunity to call your creditors to discuss it. Typically, a consumer with a good payment history will be maybe the right incentive for a credit card to negotiate its interest rate rather than you leave for another offer. So it's always the best step to just reach out, call, and find out if you can negotiate a better deal for yourself. And as mentioned, if you do have good credit history, most likely that credit card company will be there to help you and will want to work with you. So if you can consolidate those loans, find those credit cards that perhaps are offering the 0% interest for a year. You can then transfer balances over. So there are a number of different ways of consolidating those so that then the payments become more manageable and it gets it paid off that much faster. And the last one here is to not withdraw from retirement accounts. I get many individuals that will ask me about taking money out of their retirement account to pay off their credit card debt. This is definitely not the account to withdraw from to pay off credit cards, because as we know, credit cards are kind of a vicious cycle, and retirement accounts are earmarked for just that, for retirement. So the best thing to do is just leave the money, find other ways through perhaps consolidation, working with credit card companies to minimize the impact on your monthly pay, but to then also be able to pay those off through other sources, but not through your retirement account. Now we do have some tools that you can use You'll see here that you can get started to build a budget now by visiting budgetcalc.connectwithpru.com. We'll have your other resources out there that you can utilize as well. And as I mentioned, there is a budgeting worksheet that we have available on our preparewithpru.com website. You can obtain it there, but even if you do a search through Google or Yahoo for budgeting worksheets, I'm sure you will find a whole host of resources that will provide you with one that you can utilize. And lastly, another key action, as we know, is to make sure that you allocate your investments. Talk a little bit about the investment strategy. It is important that it's about saving, no doubt about it, but it's also about making sure that there's an investment strategy in place that works for you. You always want to monitor your goals and your objectives. What type of an investor are you? Conservative, moderate, aggressive? What is your time frame before retirement? And this is an ongoing process, as we know, just like life is. And so with regard to your investment strategy, review it. When you get your quarterly statement, look at that information. If things change in your life, then you'll perhaps want to use some tools in order to ensure that you truly are still that particular type of investor so that you can make whatever adjustments are necessary. Need to rebalance your account at least once a year, because as we know, there are certain funds that will begin to outperform others. And so rebalancing means that you're going to utilize the concept of what investing is all about, and that is to buy low, sell high. That's what rebalancing your portfolio will do. If you are the do-it-yourself type of individual, then you'll want to go into your account annually and then make sure that you set up that rebalance so that you have the right mix of investments, but that the percentages that you allocated to those various funds are what you originally started with. So this is an important piece of the asset allocation that is building that portfolio and ensuring that it stays true to those long-term goals. And then lastly, you want to adjust over time, because we age, we get older, and therefore we want to make sure that our portfolios are also in line with our time frame. You don't want to be someone who's 64 years of age who may be retiring in 1 year with 90% of your portfolio invested in bonds with only, or excuse me, 90% in stocks with 10% in bonds. That may not be the right approach. So we have to also factor in the years that we have left before retirement. These are very, very important elements when we look at our investment strategy and how we have our portfolios set up. So monitor them on an ongoing basis, rebalance at least once a year, and make sure that you adjust for the time frame that you have before actually accessing those dollars in the future. Now, if you have money in outside accounts or other employer-sponsored plans, then you might want to consider rolling over those assets into your current plan, because it does make it easier to manage. It's potential lower cost. Of course, you avoid any taxes and penalties, and you can manage your asset allocation. That is, you can have all of that money in one place, all growing together, and invest it the way that you wish. The other thing, too, is that it definitely makes it easier on your beneficiaries, because you want to think about your loved ones. If you have money in various places and they're not aware of that, it's not going to be necessarily a very pleasant experience for them. So think about consolidating. It's one statement, one call center, one website. Makes it easier on you. In this day and age where we have so many different user IDs and passwords that we have to remember, this just makes it simpler for you and for your loved ones. And with regard to budgeting, it is a process. It definitely can be a little bit intimidating, a little challenging. It's not necessarily, as I mentioned earlier, the top priority on our list of things to do, because sitting down and doing a budget takes some work, and it takes honesty. You have to really dig deep and say, well, yes, I do spend my money on this and that, and start tracking, like I said, those mystery expenses. So we do have a budgeting worksheet, though, that will help you look at yesterday's, today's, and tomorrow's costs, and also things to keep in mind and to consider Also encourage you to continue to save that additional 1% per year, but now you'll notice that you'll be able to itemize your monthly income, your yesterday's expenses, your today's monthly expenses. So it goes through that list, so that you don't have to do all of that work yourself. So it's really going to give you a way of itemizing all of that and then seeing where you might have some opportunities to set some of those dollars aside for your future financial well-being. So these are this budgeting worksheet, once again, is available to you through the preparewithprue.com website. There are other resources, but this will also be provided to you in a separate email if you wish to access it in order to create and put together your own budget. With that then, Renata, I will turn it back over to you.
Thank you, Dallas. We appreciate you sharing your time and knowledge with everyone here today. As you said, we'll now start addressing some of the questions that have been filtering in. And if you guys have any other questions as we go through these, feel free to put those into the webinar menu. So our first one here is, in regards to debt, is it suggested to take out a 401k loan to pay your mortgage?
That's a great question. That's something that, it does come up. And again, I think it's all about really looking at the advantages and the disadvantages. Now, keep in mind, you're looking at, what's the interest on your mortgage versus, what's the interest rate that you're going to pay back to yourself through a 401k loan. But the key thing here is that when you borrow from your 401k, then whatever that amount is that you have borrowed from yourself is not working for you. That is, it's no longer earning money on your behalf. So that there potentially will be lost earnings on those dollars over time. The second piece of it is, and where we tend to forget, in most 401k plans, you're saving on a pre-tax basis. The money then that you borrow from yourself, you haven't paid any taxes on. So that's a pre-tax loan that you are receiving. The payment that you make back to yourself through automatic payroll deduction is with after-tax dollars, meaning that you're putting the money back into your account on an after-tax basis, which means that the dollars in the future, once you start accessing them, will be subject to tax again at that point in time. So there are a number of things to consider when you're looking at borrowing from yourself. There's that impact on the potential growth on your dollars, after-tax dollar payment, but you're borrowing pre-tax. And the other thing is that if you were to leave your employer, and let's say that you still owed on that loan, if you aren't able to come up with whatever that outstanding loan balance is, then that will become taxable income to you because now it's considered a distribution. At the time that you file your tax return, you have to declare that amount as income, and you will be subject to a 10% penalty if you are not age 59 and a half. So it's really about thinking, is it worthwhile to borrow even though you're paying yourself back versus just continuing to pay the mortgage as you are and building up your retirement savings. So it's a balance of the two. But, there are, like, anything in life, there are consequences to any action that we take. And some of them are positive and some of them are not. So you have to weigh the two. But typically, we discourage, if you will, loans from a plan for whatever reason, because there are certain consequences associated with that action.
Great, thank you, Dallas. And then another question that came in here, how often should I update a budget and how do I budget for one-time expenses?
For one-time expenses, I mean, if that's, referring to perhaps like something in the future, if you're looking at a vacation or wedding or something along those lines, it's really about putting that savings plan and putting together kind of a time frame. If you know that you're going on vacation next year and you're going to need X amount of dollars, then it's, let me put some of the let me figure out what I'm going to need to set aside for that particular vacation, and then budget accordingly and put those dollars in some type of a savings or short-term investment vehicle, if that. But putting together a budget, it's really a matter of just setting it up and then kind of keeping track of it. It doesn't have to be all the time, but it's just a matter of knowing what are your expenses, what is your income, and how are you tracking that to make sure that you're not going over, or that that you're letting things get out of control. But for one-time expenses, it's really just, again, it depends on what it's for. But if, I know, for example, yes, if I'm going on vacation, or if I'm going to purchase a car, or something that, like you say, is that one-time expenditure, then it's planning it out. When are you going to need the money? How much is it going to cost? And then what do you need to start saving today in order to reach that goal for that type of one-time expense that you're looking at?
Great. Thank you so much again, Dallas. As always, any of you listeners can reach out to your dedicated service team at the ACEC Financial Wellness Center for any plan-specific questions. That will now conclude this webinar session. Thank you again, Dallas, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.